Hi, I'm Toby Lynn. I'm so glad you're watching my YouTube information. And I want to talk right now about credit scoring because it affects all of us. It not only affects the mortgage rates, which is why I'm hoping you're watching this, but it also affects things like our insurance rates, buying a new car. If you're going to purchase a car anytime soon and finance it, it'll affect your rate as well. You probably know that there's 3 credit bureaus: Equifax, TransUnion, and Experian. Mortgage lenders pull all 3. Car dealers might just pull one, different creditors might just pull one depending on the region you're in, but mortgage lenders pull all 3. And we're going to use the middle score as your qualifying score. So let me give you a couple tips right now. 35% of our score, the consumer score, is based on pay history. That includes the recency of late payments. So a late payment last month is way worse than a late payment 5 years ago. The recency is very important. The frequency is very important. Does somebody have late payments that are just one here, 1 3 years before, or is it a trend? And then the severity. So how long was the borrower late? 30 days, 60 days, 90 days. And then you go to collection, and then you potentially go to judgment. And then, of course, there's also even worse, public records, which would include bankruptcies and judgments, tax liens. Tax liens would be another example. So those affect the rate. 35% of our score has to do with this, pay history. 30% of the score is going to be based on credit lines. What is your balance versus your available line on revolving debt? This doesn't have to do with car loans or student loans or even mortgage loans. So if you have a Visa card, for instance, and you've got a $1,000 limit on it, your best benchmarks are going to be 35%, so under $350 on that $1,000 line, 50%, 75% starts getting considerably worse in terms of affecting our score. And then once you go over 75%, and up to your limit, and oh my gosh, if you go 10 cents over, that really gives you a double whammy. So that's going to be very important. That's 30% of our score has to do with that. 15% of the score has to do with how long a credit line has been reviewed. So this is one reason why, ever since credit scoring came about, mortgage professionals, such as myself, do not recommend that you close revolving debt credit line. So for instance, I have a Chase Visa card that I have had since, yikes, I think it's 1987, and an American Express that's been in my wallet since maybe 1996. They could not make me mad enough to make me close those accounts because the length of that revolving card definitely helps the score. So the length is important. A lot of times we might recommend to somebody that they open new credit lines. That's not an instant benefit on a score. The longer somebody has those lines and uses it in a positive way, the better off their score is. And then there's another 20% left, so 10% is determined by the revolving trades that you have. Ideally, somebody will have 3 open trade lines. That's going to be the ideal formula for the best score, and use them, again, according to the formulas. And then 10% is based on inquiries. So if somebody's going out and willy-nilly shopping all over the place and opening new credit, that's going to affect 10% of the score. I'm Toby Lynn, and I would love to answer your personal questions if you have any. You can call me or text me at 404-786-5953. I hope you're having a great day, and I look forward to helping you with your mortgage financing. Bye.